Hello everyone, I'm Sebastian Y and this is Foundations of Economics. In this set of videos, we are going to lay the groundwork for the next part of the course on industrial organization. Industrial organization is the study of how firms operate in different market structures. This set of videos will cover the concepts of profit, production, and cost. There are a lot of technical terms here that we are going to use over the next few sets of videos, so it's important to have these down before we move on. A firm's goal is usually to maximize profit, but how they go about that depends on all kinds of different things, including how many firms there are, how easy it is to enter and exit the market, what the demand curve is like, and what technology is available to the firms. Understanding the cost structure of a firm is integral to understanding how firms make decisions. Since a firm's goal is to maximize profit, the first thing we need to do is define profit. In economics, we typically use the variable pi to denote profit. When economists use pi, it does not mean the ratio between a circle's circumference and diameter. It simply stands for profit. We define profit as the total revenue minus the total cost. We've already defined total revenue as price times quantity. We're now going to think about how we define total cost. Total cost is the market value of all the inputs the firm uses in production. This includes labor, capital, and raw materials. In economics, cost is defined in a particular way, which is the total opportunity cost. We divide total cost into two different components. The explicit cost, which requires the firm to actually spend money, and the implicit cost, which are costs that do not involve actually spending money. Implicit costs instead arise from what could have been accomplished with an alternative use of resources. With these two types of cost, we have two ways to define profit. Going forward, I'm going to abbreviate these as EC and IC. With these two different types of cost, there are two different ways to think about profit. The first one of those is called the accounting profit. An accountant's job is to keep track of the money flowing in and out of a firm. Therefore, we define the accounting profit using only the explicit cost. So we take total revenue minus explicit cost. The second way to think about profit is economic profit. Economists' jobs are to think about decision making, and therefore are going to take into account both the explicit and the implicit costs. So we're going to define economic profit as total revenue minus both the explicit cost and the implicit cost. This means economic profit is keeping track of the total opportunity cost. Positive accounting profit means that more money is flowing in than flowing out of the firm. A positive economic profit means that the best decision has been made. Negative accounting profit means that a firm is losing money. Negative economic profit means that a decision has been made that was not the best one. Because of the implicit cost component of economic profit, it's possible to have positive accounting profit but negative economic profit, meaning that a firm is making money but not as much as they could be by doing something different. Let's consider an example. Consider a small business owner who sells 100 units of output at a price of $50 each. In order to produce these 100 units of output, the firm spends $3,500 on inputs. These could be labor, capital, anything used to produce the goods. Had our small business owner not been running this business, they could have worked at another job and earned $2,000 in wages. We'll use this information to calculate both the accounting and economic profit. First, let's calculate the total revenue. Total revenue is price times quantity. So we have $50 times 100 units is going to be a total of $5,000. The cost of inputs had to actually be paid, so that is going to be our explicit cost. The $2,000 that the business owner could have made working in another job is not money they're actually paying out of their pocket, but rather that is an implicit cost because it arises from an alternative use of their time. So that's going to be an implicit cost. Calculate the accounting profit. We take our total revenue of $5,000 and subtract the explicit cost. And we get $1,500. This means the business owner is making money. More money is coming in than is going out. But if we calculate the economic profit, we take our total revenue and subtract our total opportunity cost. So we're going to subtract the $3,500 of explicit cost, but also the $2,000 in implicit cost, and we get negative $500. This is an example where the accounting profit is positive, but the economic profit is negative. Even though they're making money, it's not as much as they could have gotten doing something else. The $1,500 of accounting profit does not exceed the $2,000 that they could have made doing something else, so we have a negative economic profit, meaning that they could have done better doing something else, in this case, working the alternative job. In the next video, we're going to get into more detail on how firms operate by looking at production.